What did you do in your early years?
In fact, we overlap. I was a valet driver as well. That job may not exist in a few years with autonomous vehicles, nor will parking lots. So. Hi, I'm Ren Leggi, ARK's client portfolio manager. On this season of The Switch, we'll be addressing 4 market inefficiencies related to innovation within the public equity markets. As always, we'll be joined by ETF trends to facilitate the discussion and make sure that we don't leave anything unanswered. So let's get the conversation started with passive public markets.
Hey, Ren, let's kick things off. I started my career in passive investing, index investing, and y'all run some passive funds. So clearly indexing isn't a bad thing overall, but you guys have some interesting thoughts about how passive has changed the opportunity set for some of your other products. Tell us what you mean by that.
Yes, so there's always a place for passive, right? We've just seen there's been a huge surge just over the last decade of investors going more passive. And what's happened is that's created a market inefficiency related to these innovative stocks. Indices, by definition, are backward looking, right? So they're built on, in some cases, especially the market cap weighted ones, they're built on past success, right? And that's not indicative of future success. So when you're taking kind of a more thematic approach, you're looking forward and seeing, well, what is the world going to look like? And so the passive approach, may not be good when focused on investing in innovation, right? You have to have that forward-looking view in understanding how big these opportunities will be.
Hey, Ren, there's been a drastic decrease in the number of companies that have been going public in the last 10 years. They're down by almost 2/3. At the same time, a lot of investors are trying to invest in innovative companies and are doing so through private markets. So how does that all work as you look for companies of the future?
Yes, we've seen, and this is another trend that's probably been about a decade, a lot of investors have been seeking innovation through private markets. And what we've seen there been valuations that are running up. And when you compare it to some of these innovative stocks in the public markets, the ones that we're focused on, we're seeing that valuations are maybe 5 or 10 times higher in the private market compared to the stocks that we owned. So it's providing a very attractive opportunity from a valuation standpoint, one that everyone talks about. So we see it as an opportunity to take advantage of that inefficiency out there.
I started as an investor back in the 90s. I was running a tech fund. And one of the things that I relied on, frankly, was the analyst community and investment banks who were out there helping seed some of these young companies, get them to market. And by the time they'd show up as a publicly investable security, I had a pretty good sense of the research behind that company because there were real hardcore analysts doing that work. Doesn't feel like that's true anymore. As Tom points out, a lot of that IPO market's dried up. Some of it showed up in SPACs. So where do people look for that kind of research, or does it just not exist anymore?
Well, Dave, actually what's happened in just the last, I'd say 12 to 18 months has been kind of that reversal, right? Where we're starting to see a surge in IPOs and actually more so in SPACs. And this is opening up the market, right? Mainly, innovative companies are coming public. So the universe is actually expanding. And that's creating more opportunities. Now, on the research side, we would agree, right? The type of research that's being conducted from traditional kind of Wall Street analysts is not up to par with how they should be structuring their research for these innovative companies, right? You can't fit them into a bucket or a sector anymore because technology is really seeping into every sector and industry. So you have to restructure kind of your research and analyst team to conduct more efficient research and understand these opportunities much better.
So Ren, when you think about research today, what are the key things, especially as we move from private to public markets that you folks are finding are working the best for you?
Yes, it's keeping our focus on the top down initially, right? Sizing these opportunities, looking at cost declines, looking at the adoption rates, and sizing those opportunities and seeing how big they're going to be, right? 5 or 10 years out. And that helps us with our bottom up process, where we're looking for kind of the best or maybe the select group of winners in each of these technology areas. So we have a very detailed kind of scoring framework where we're identifying what those leading edge companies are. And that is informing kind of the team on how to position these individual stocks within the kind of portfolio.
You know, one of the things about the new companies coming to market, you mentioned SPAX, right? That's a fairly new vehicle in its current format. And one of the criticisms of SPACs is that often what ends up happening is these companies get massively overvalued out of the gate, right? It creates a lot of value for the company in the sense that it gets to raise money at a higher valuation than it might have in the old model where you went out of 10 and it popped to 30 in the first trade. And that money doesn't go to the company to generate, the actual resources it needs to grow. How do you think about that? Are you guys really excited when a company comes to market with a SPAC, or do you feel like now's the beginning, you have to really get under the hood because there can be valuation concerns?
Couldn't agree with you more, Dave. You have to be. Valuation is certainly probably the most common reason why we don't invest in some of these SPACs. You have so many coming to market, right? It is opening up the universe. But some of these SPACs are going after technologies that may not make sense for an early stage company to go after, like for instance, space exploration, right? There's a number of SPACs that have been, just kind of initiated where, we don't think that these companies, they're more binary, if anything, right? It's either it's going to work or it's not going to work. And we try to avoid that, right?
Yeah, coin flips are generally bad investments.
Yes.
Yeah.
Exactly. And valuation, right? When we size these opportunities, because we've seen some of these private valuations, right? Back to our earlier point, these valuations being much higher and they're going public, that's steered us away. Now, there are some very interesting ideas. I'd say maybe the most exciting area that we see where a lot of these opportunities are starting to kind of come to market and we've been, participating in is within the genomic space. These are some of these private companies we've been following. They've been kind of under the radar. Now that they're coming public, and some of them are coming public at multi-billion-dollar valuations that are justified, and we can still hit our 15% annualized hurdle rate of return on some of these, but they're less talked about. So the big ones, the big unicorns, typically when we do the valuation work, we just can't get to that hurdle. But some of these others that are flying under the radar have been pretty interesting ideas.
Hey, Ren, we've heard a lot from Dave about his past work history. I was a car parker and a bartender, which really put me in a good position to be a qualified analyst today, especially regarding EV. I think they should bring back the Gremlin and the Maverick in an EV form. What did you do in your early years?
In fact, we overlap. I was a valet driver as well. That job may not exist in a few years with autonomous vehicles, nor will parking lots. So thanks, guys. We'll see you next time on The Switch.